Picture a bank approving a mortgage. Somewhere in a vault, or so the story goes, sits a pile of money, other people's savings gathered up over years, and the bank is simply moving a slice of that pile from the vault into your account. That's the version most people carry around in their heads. It's the version taught in a lot of introductory economics classes, and it feels intuitive enough that almost nobody questions it. It's also, according to the Bank of England itself, not what actually happens. In 2014, the Bank of England published a paper that quietly overturned decades of textbook explanation. Its conclusion was blunt. Banks do not lend out the deposits savers place with them. When a commercial bank makes a loan, it isn't handing over money that already existed somewhere else. It's creating brand new money, on the spot, through nothing more than a keystroke in its own accounting system. To understand how strange that is, you have to see what actually happens the moment a loan is approved. Say a bank agrees to lend someone $40,000 for a car. In the old textbook version, that $40,000 would need to come from somewhere, pulled out of the reserves the bank is holding or out of another customer's savings account. In reality, the bank does something much simpler. It opens the borrower's account and types in a new number, $40,000, sitting right there as a deposit. At that exact moment, before the money has gone anywhere, before it's been spent on anything, new money has come into existence. Nothing was taken from another account. Nothing was withdrawn from a vault. The bank created a liability to the customer, the deposit. At the same instant, it created an asset for itself. The loan the customer now owes back, plus interest. This is why economists who study the system closely describe it with a simple phrase that runs backward from how most people assume it works. Loans create deposits, not the other way around. The everyday assumption is that people save money first. Banks gather it up, and then lend it out to borrowers. The actual mechanism runs in the opposite direction. The act of lending is the act that creates the deposit in the first place. This isn't a fringe theory. It comes directly from the central bank that oversees the entire British banking system, and similar explanations have been published by Germany's Bundesbank and echoed by researchers using empirical tests specifically designed to check which explanation actually matches what banks do in practice. Those tests found that banks aren't simply moving existing deposits around, and they aren't multiplying up a fixed pool of central bank reserves either, which rules out the two most common textbook explanations at once. They're originating new money directly every time they extend credit. For decades, the standard classroom explanation was something called the money multiplier. A bank takes in a deposit, is required to hold back a fraction of it as reserves, lends out the rest, that money gets deposited somewhere else, a fraction of that gets held back too, and so on, with the total money supply theoretically expanding as a multiple of the original deposit, constrained by the reserve requirement at each step. It's a tidy story, and it's still printed in plenty of textbooks. It's also, according to the Bank of England's own research, not how the sequence actually runs in a modern banking system. Reserves don't come first and get multiplied outward into loans. Loans come first, and the reserves banks need get sourced afterward, largely by borrowing them from each other or from the central bank itself. If that's true, you might reasonably ask why banks don't just create infinite money by approving infinite loans. The answer lies in what actually limits them, and it isn't a vault of cash running low. The real constraints are risk and regulation. Every loan a bank creates becomes an asset on its books, but it's an asset that only has value if the borrower actually repays it. If a bank makes too many loans to borrowers who can't pay them back, those assets turn bad, and the bank can become insolvent, its liabilities to depositors outweighing what it can actually collect from the loans it made. That risk alone forces banks to be selective. On top of that sits a web of regulatory requirements, capital rules that force banks to hold a buffer against potential losses, and liquidity rules that require them to hold enough easily accessible reserves to handle the ordinary flow of withdrawals and payments between banks. A bank can't lend without limit, not because it physically runs out of money to hand over, but because regulators and its own solvency require it to hold enough capital and liquid reserves to back up what it creates. There's also a quieter constraint that matters just as much: demand. A bank can only create new money by finding a borrower willing to take on debt and capable of convincing the bank they'll repay it. When people and businesses feel confident about the future, they borrow more and more new money enters the economy. When confidence collapses, during a recession for instance, borrowing dries up, loans get harder to obtain, and the same money-creating machine that had been expanding the money supply for years can suddenly slow to a crawl or even shrink it as old loans get repaid faster than new ones are created. This is part of why central banks watch lending activity so closely during downturns. The money supply isn't a fixed quantity sitting in reserve somewhere, waiting to be spent. It expands and contracts based on how willing banks and borrowers are together to keep the cycle of lending going. This mechanism explains something that puzzles a lot of people about modern economies. Why more than 97% of all the money in circulation today isn't physical cash at all. It exists purely as numbers in bank accounts. Electronic entries created the moment a loan was issued, moved around every time someone pays a bill or swipes a card, never once needing to take the form of a printed note. The pile of cash in a vault, the image most people default to when they picture the money supply, represents a tiny fraction of what's actually out there. The overwhelming majority of it started life as a line of code entered by a bank employee, or increasingly an algorithm, approving somebody's loan. None of this means banks operate without limits, or that the system is somehow reckless by design. It means the limits are different from the ones most people assume. It isn't a fixed pile of savings running low. It's solvency, regulation, and the willingness of borrowers to take on debt. Three forces working together to decide how much new money gets created and how much gets destroyed every single day, largely out of sight, inside the accounting systems of ordinary commercial banks. The next time you watch a loan get approved, a mortgage, a car loan, a business line of credit, remember that you're not watching money move from one place to another. You're watching it get created, out of nothing but a promise to pay it back, becoming real the instant someone agrees to owe it. If stories like this one stay with you, the ones where a system this powerful was built so quietly that most people never noticed, subscribe, because that's exactly what this channel is built around. And if you've got a question about how another part of the financial system actually works, drop it in the comments. Some of the best topics on this channel started as a suggestion from someone watching.